Last week, Jerome Powell continued his reign of error, releasing his inner dove and admitting the Fed, as always, serves Washington first. FX hedgers did a great write-up of Jerome's clusterfest, but in short, the Fed's getting back to inflation, but it's not doing it in a way that actually helps regular people. It only helps Washington. First, the details. The Fed left rates unchanged at 5.25 to 5.5, which is historically on the high end, but it announced it is implementing a shadow cut by reducing the amount of government bonds it sells by letting old debt expire. It's cutting the amount from $60 billion a month to $25 billion a month, which effectively increases money printing by a cool $420 billion a year, about 2% translated into inflation. Why do this when inflation is already reaccelerating to the 4 to 5% range? Because slowing their treasury roll-off reduces the cost of borrowing for Washington. It means they can sell cheap debt to the Chinese and, of course, to Wall Street. So Washington gets cheaper borrowing, the rest of us get more inflation. The background here is that during COVID, the Fed printed $6 trillion and injected it into the economy mainly by buying a $5 trillion mountain of assets. That was made up of government debt and mortgage-backed securities. This took the Fed's balance sheet, the assets it owns, from $4 trillion all the way up to $9 trillion, which is nearly half of all dollars in existence. For perspective, during the 2008 financial crisis, the Fed only increased its balance sheet by $1 trillion. Before that, in the 95 years the Fed had existed, it had only bought $900 billion in 95 years. So 95 years for the first $900 billion, doubled at a stroke for Wall Street, and then quintupled to bribe voters into lockdowns. That $5 trillion mountain, of course, raised questions whether the Fed is buying up the entire financial system. Not to worry, declared Jerome Powell, we will just sell it off, effectively vaporizing those freshly printed dollars since, after all, the COVID emergency was over. Of course, the Fed lied. Now, this shouldn't be a shock. Bernanke also promised to neutralize the 2008 money, but he gave up in a matter of months when Wall Street choked. The financial press called that the, quote, taper tantrum. This time around, they apparently got from $9 trillion to $8 before now slashing the program. So what's next? Brought to you by Unchained.com. The Fed's balance sheet roll-off had been taking some of the edge off inflation, soaking up $8 trillion a year. Jerome just cut that by a third. More important, the Fed is now signaling that it's going for the stealth inflation instead of the old-fashioned kind that you do with interest rate. That means shifting the Fed's money printing from interest rates, where at least they make mortgages and car loans cheap, to instead aiming the flood of money directly where the Fed's political masters need it, federal spending. There's one more step in fiscal dominance when government spending takes over the entire economy, and the Fed is apparently happy to play along, reducing costs for the government and leaving the rest of us with the inflation. Read the rest over at FX Hedgers with charts and plenty of gory details. Okay, we'll be watching. See you next time.